America's accountant, Dan Geltrude. Dan, thanks for being on the show. All right, I mean, both of those aren't very good choices. More bank contagion or more inflation. What say you?
Well, it's all. I mean, how can you start off with something like that? You can't throw me a softball. Listen, Scott, we are in a tough situation now. I don't want to say that I'm worried about what's happening, but I'm certainly concerned about what we're seeing. Look, what the president said this morning, I actually agree with. Okay, we need to protect the depositors, all the depositors in these two banks to start with, which is Silicon Valley and Signature. That's the first place. That is different from a bailout, okay? When you're talking about having to save investors, investors are going to have to deal with, being big boys and girls in terms of where they put their money. But in terms of the deposits, if those deposits are not protected, then chaos ensues. Think about how many businesses have balances above $250,000. If that money is not there, you will see many, many businesses literally go away overnight.
Are we worried about something that's really only ever happened back in the 1930s? I mean, how at risk are the balances over $250,000? Because we're made to believe that this insurance fund that all these banks pay into will be more than enough to take care of all that. But at some point in time, there has to be an end to that rope too, right?
Well, yeah, and the end of that rope goes to the taxpayers, right? So then if it takes us printing money or whatever it takes, then we do it. Look, Scott, even when you go back to 2008, and a lot of people were upset about using taxpayer dollars, essentially, to be able to bail out the banks. I granted it's not great. However, if you look at what the alternative would have been, which would have been the crash of our financial system, and as a result, the crash of the world's financial system, and I'm not exaggerating in saying that, we had no choice. So if we have to keep people calm right now, and I don't think these are the only two banks that are probably in trouble. There's probably some more out there, but I think we need to do what we have to do for right now to keep these banks, or I should say, to protect the bank customers. If the banks go under, okay, but the depositors, they can't lose out.
Do you know how much that insurance fund has in it? I mean, does anybody know about how deep that thing is? Because if we do start to see more and more lines wrapping around the corner as these folks try to get their money out of these banks, I mean, it's a psychological problem, right, Dan? I mean, that's one of those things that I think that scares most regulators and or anybody in the government, because once you lose the psyche of the people, that's something that is very difficult to get back. And if folks are afraid, they act irrationally, and no amount of massaging the markets or bailing the markets out will kind of get that trust back anytime soon.
Well, Scott, you're starting to talk about the unthinkable, right? When you have the possibility of a national run on banks. I mean, yes, there is not enough money in the insurance fund, and there is not enough money available even in the banks, right? Because you're talking about what they keep on reserve, because the banks take your money, take your deposits, and they go out and invest it.
Right.
So that money is, for lack of a better term, out on the street making money for the banks. So it's simply not there. So if we end up in the again, unthinkable, where we end up having to print money to save the banking system, which is a terrible thing, then that's where we land. I hate to say it.
Well, this one so far has been mismanagement of this particular bank. The reason why I think it's more serious is because I'm sure other banks have mismanaged themselves very similarly. There's just never just one. But just so the viewers understand, that bank's Silicon Valley Bank took in so much capital, it was taken in very fast. It really didn't have enough time to do due diligence and make good loans, so they went to the market and bought treasuries for the yield on the treasuries, right? But they got caught really in a duration trade. Those treasuries were too long dated, so when it came time to try to raise cash and sell them to get the cash back, they had already moved in price, and the price moved against them. Had they held them to maturity, it wouldn't have cost the bank anything. But when you need cash today, you have to take a haircut, and that's really what that $1.8 billion was. And then they went searching for another $2.25 billion. and everybody gave them shrugged their shoulders and said, we can't do that, right?
That's exactly the summary of what happened. And you can go with cause and effect to that, Scott, and say, wait a minute, why were those treasuries priced so high?
Exactly.
And that goes back to inflation and how the Fed is reacting. So all this stuff is interconnected.
It's whatever bus you want to jump on. The government spending too much money, the Fed not, being asleep at the wheel and not starting to raise rates when they should have, or mismanaging your own bank and buying these bonds that were too long dated. Everybody's got a little bit of culpability, I think, along the way. But it's going to be an interesting class in some finance school in about 10 years' time, that's for sure. I really appreciate coming on. Dan Geltrude, Nutley, New Jersey.